Welcome to AEC Unscripted M&A Edition, your go-to podcast for unfiltered conversations and expert analysis. Brought to you by Stambaugh Ness.
Welcome to AE Unscripted. I'm your host, Jeff Adams, the Director of Mergers and Acquisitions at Stambaugh Ness. Private equity has been around for over a century, but it began picking up steam in the latter half of the 20th century. Now, here in the 21st century, we've seen PE take a strong interest in the AEC industry. Today, we're going to be exploring the world of private equity and its involvement in the AEC industry. I'm delighted to have joining me Ira Starr, the Managing Director of Long Point Capital, a private equity firm co-founded by Ira in 1998. Ira has served as a general partner of funds with private equity investments, including over 40 in the AEC space. You may be familiar with some of them: Wolpert, CHA Consulting, EYP, Cumming Group, and now M&S Engineers and All North Consultants. He holds a Bachelor of Science and Engineering degree from Princeton University and an MBA from Harvard. Ira, how are you doing today?
I'm great, Jeff. Thank you for having me.
Ira, I've got to ask you, you graduated from Princeton with an engineering degree. How in the world did you wind up in private equity?
That's a good question. Jeff, my career has basically been dictated by figuring out what I don't want to do. I grew up in my father's plumbing supply store, working there every Saturday, and I hated doing that. So I knew I didn't want to work in a retail store selling plumbing supplies. Got to Princeton. I was a good engineer. I was a good math and science student, tried engineering. I just didn't want to do engineering as a career. Business seemed more interesting. It was around the time Apple went public. So I took a job at a strategy consultant, Booz Allen. I thought that would be of interest. It was a great background, didn't want to do strategy consulting, got an MBA to make a switch, thought I wanted to get into the venture capital industry, but ended up doing investment banking for leverage buyouts. And luckily, one of my clients took a liking to me a couple of years in and said, "Would you like to join us doing private equity?" So I've been doing private equity for over 30 years at this point.
Very good. So you never really practiced engineering, just went kind of straight into being an investment kind of guy.
I never practiced. The value of the degree really is that I know what engineers do.
Absolutely.
So I can, empathize with what they do and how difficult it is and, what their life is like. But no, I never practiced.
And
But I do.
probably think like one a little bit as well.
I clearly think like an engineer.
You started your firm in 1998, right? So what was your first investment?
First investment was a building products company. It was called Arch Aluminum and Glass. They made fabricated glass products. So they took raw glass and made tempered glass or laminated glass or insulated glass panels. We really did a lot of building products work at that point. It was very successful, and I'm still friendly with the CEO of the company.
So didn't exactly start in the professional services or AEC space with your first investment. At what point did you make that transition?
We tended to do a lot of building products. When we started the firm, our main investor was a large building products company. So we tended to be viewed as building products experts. And really, I spoke at a lot of conferences about the building products industry and really just started looking at the entire construction industry and realized that we were missing out on a large part of the construction industry, which was the design side. So we started focusing on that around 2005, 2006. We viewed it as a great place to invest. Number one, it was a pretty stable, parts of it were a very stable industry, notably the pieces that were focused on infrastructure and what I call institutional building versus residential. A lot of people were scared off on the residential cycles. We saw a lot of reoccurring revenue from essentially clients who work with the same consulting firm year after year after year. It wasn't the same project, but there were always projects to do. And we're probably one of the first 2 or 3 private equity firms to be investing in this space. So there was just a large number of transactions we could evaluate. I would say that the issue back then was convincing the engineering firms that private equity wasn't the evil empire and was actually a good partner. But we viewed it as a great area to invest in.
How do you feel now, Ira? You mentioned the evil empire. Do you still face that sometimes, or feel people are still trying to figure it all out?
It's easier now because we can go back and reference all the great deals we've done. And we just say, if you're worried about it, just pick up the phone and talk to one of the CEOs of one of the prior companies. It's still in a lot of people's minds. They're very nervous about it. I mean, the first thing I do when I talk to any company who's never had a private equity investor is like, what is private equity? And why is it helpful to you? Why we can be a good partner for you, and why we're not out to basically cut people and split up the company, all the things you read about in the papers. I would say the private equity firms that do that are out there. It's a pretty small percentage of the firms that actually do that. Most of the firms out there are pretty good partners for management teams.
Yes, certainly. And I guess private equity kind of varies by industry, right? So, like in manufacturing, maybe part of the synergies, part of the value that private equity is able to bring a lot of times is through G&A synergies, which does involve reducing cost and consolidating.
It can. What you're trying to do is you're trying to grow profits. So sometimes it's cost cutting, sometimes it's revenue growth. In the AE space or professional services in general, we're generally, or I would say always adding people, because the only way to grow a professional services firm is to add people, because basically you're charging for people's time. And if you don't have the people, you can't charge for their time. So our goal in every case is to grow the firm by adding people. We're generally adding people on the management side. We're adding people on the billable side. And what we're trying to do is we're trying to make the firm an employer of choice. It's really key for us to be viewed as a great place to work. For a professional services firm, you really need to show that you're growing, because to attract really good talent, they want a career. They're not looking for a job. Great people want a career, and you don't have a career unless the firm is growing. And so it's really important to show your outside constituencies, namely the people, that you can grow, because otherwise you're not going to get good people.
Well, and you mentioned with people being the main source of revenue for AE firms. I can't recall the last time I heard someone say we've got too many people looking to get rid of some. So there is an overall shortage in the industry, and everybody's feeling it.
It clearly is today. It's much more important to be viewed as an employer of choice today. I will say that I've been doing this for a long time. At various times, it's much easier to attract people. These days, the chief constraint to growth is good people.
Yeah, absolutely. So Ira, so you mentioned you started out with a building products background type investor, and so naturally invested in building products. How did you go about determining where to invest funds from that? Just you went straight into AE, I guess, from there, or was there some steps in between? Just in general, how do private equity firms go about deciding what industry to go in?
There are a lot of different kinds of private equity firms out there, so I can't generalize. Some private equity firms have a specific industry focus. Some private equity firms are pretty opportunistic. I would say that originally we were pretty opportunistic. We did everything from logistics to building products to we even did a restaurant deal. Um, when we started focusing on professional services, we just saw it was more unique. And I would say probably the most important thing about professional services is the leadership of the companies are really wary about who they bring in as a partner. So it's not just we're going to sell to the highest bidder, because if they sell to the highest bidder and they keep equity in the company, what happens is they could end up with a bad partner, and having a bad partner could drive people away, and you get into a death spiral. and you really need to. So I like to say that any professional services firm, if they're going to pick a P partner, it's got to be a P partner that has an aligned strategy, has an aligned culture, um, has an aligned way of partnering with the management team. So, and I say that. So we started focusing on professional services, and really one of the things about professional services is the more you do, the more successful you are, the more you can attract other investors because they trust you. I mean, we've had companies, we're one of the original leaders in it. We have companies that are on their third private equity firm. We have companies that grew from less than 8 of EBITDA to over 150 of EBITDA at this point.
Oh, wow.
So we've got a really successful track record of making these companies, I say, growth oriented, resilient, stable, and can grow. We don't build houses of cards, and it's valuable when we're talking to new management teams because they just pick up the phone and talk to people and can see what's happened.
Yeah. Well, Ira, you mentioned some of a couple of things a while ago about what kind of drove your interest in the space, but I want to just step back a little broader, just for private equity as a whole, in case some people miss that. What has been driving the PE interest in the AEC industry in recent, let's say the past 2 decades?
Well, past 2 decades. So we started investing. Our first investment was in 2006. Very few people were doing it. 2008 was our first engineering firm. Before that, it was a project management firm. 2008, I was still getting questions from my partners and my investors, like, what the hell are you doing? These are people businesses. I think it's really part of it. Part of the interest in PE has really been generated by our success and the success of a small number of other firms. And then it all accelerated due to the infrastructure plan. Once the infrastructure plan passed, I think all the PE firms are looking for investment themes. One of the investment themes was there's going to be a lot of money coming for infrastructure. How do we invest in that? And they can't own bridges in general. They can't own highways in general. I've had a friend who's owned a tunnel in the past. But in general, you don't do that. And so they started looking at, how do we play the theme? And, infrastructure engineering has been a major way for people to do it. And because our past success and other people's past success combined with the infrastructure, it's just PE firms have flooded the market in the last few years. So, 10 years ago, not so many. 5 years ago, a lot more. We sold CHA, I think it was 2016, 2016 or so. There might have been 10 or 20 private equity firms that would have looked at it. Now there are over 100.
Wow.
So it's really changed a lot, even between 2016 and 2024.
Well, Ira, you're kind of walking into something there. We hear that term dry powder, right? And I think it was like at the end of 2022, there was supposedly $2 trillion of dry powder. And now I think I hear it might be as high as $3 trillion.
There's no lack of money.
Well, explain to people, what is this dry powder and where is it coming from?
Yeah, so this is how private equity works. Private equity in general works with investors commit to provide capital to the private equity firm when they need it. And so dry powder is basically the availability of that capital. So if you have $1 billion fund and you only spend $100 million, you've got $900 million of dry powder. And so there's been difficulty finding, I think, good investments the last couple of years. It's been very slow for a lot of people the last couple of years. And so private equity firms are generally trying to invest the money over a 5-year period. So if they got their commitments 2 years ago and they haven't invested much money, there's a big emphasis to put money to work. So I think that's what you're talking about. People are trying to invest the money and they're looking for good places to put it. And the AE space has been a good place to put it. And when I say the AE industry, it's really the E part of the industry. And specifically within E, it's infrastructure E. There haven't been many people investing in architecture firms. There haven't been many people investing in what I would say other kinds of engineering firms. Industrial has not been a hot area. MEP has not been such a hot area. It's really the transportation and water oriented firms are the firms that are really getting the big investments.
And it goes without saying, I think a big reason for that, and the reason for that is we know the government's pushing it, right? There's going to be a lot of money being poured into our infrastructure in the coming years, and that's where private equity is going, right?
It is. We like the space even without the infrastructure plan. When we invested in CHA, it was December of 2008, which was a scary time to be investing in any company. It was after Lehman Brothers, basically went bankrupt.
Mm-hmm.
We viewed it as they were doing work that had to be done, no matter what, and so there's a lot of stability. And literally, we went back before we made the investment. We called a bunch of their top clients and we said, "Well, looks like the world economically is falling apart. Are you going to continue to give CHA work?" And the answer was, "We have to." And so that's sort of been our theme throughout the years. We don't need the industry to be growing rapidly. It's a giant industry. There's always ways to grow by providing additional services to your clients, by doing add-on acquisitions that help you grow strategically. So the infrastructure plan has accelerated, but I think the infrastructure plan has just brought more attention to it than anything else, and it's made it more competitive.
Well, and as you mentioned, there were 10 to 20 firms back in 2016 that you felt like
Yeah,
would be interested in CHA, and now you think there'd be over 100. So
clearly over 100.
I'm kind of putting the pieces together, saying, all right, the infrastructure bill has kind of driven it, 5, 6 times or more
It,
interest of private
it,
equity in the industry. What do you think that says for the future of private equity in the industry? Do you think there's going to come a day where it's just the 10 to 20 that are back in there again and the interest kind of wanes and private equity money goes elsewhere?
well, this gets to the whole, public versus private market. I think private equity is going to continue to grow. There are fewer and fewer reasons to be a public company, and there are larger and larger private equity firms. So even, you know, 10 years ago, I would have said if we had a $50 million EBITDA, engineering firm, there would be a limited number of buyers. Now you could easily have a $200 or $300 million EBITDA engineering firm and find buyers for it. I think private equity is gradually just replacing public equity in a lot of cases. So I don't see any shortage. It's going to continue to grow. It's not only going to continue to grow where we are today, it's going to continue to grow to other sectors of the AE space.
Okay, so you see private equity as a whole continuing to grow, the dry powder building and all that as more and more investors climb into the private equity space. But you also, what I'm hearing is you feel like they won't be leaving AEC in the foreseeable future. It's something here to stay.
I said, oh, it's clearly here to stay. What's interesting is we haven't had any disasters. Maybe there have been, but I haven't heard about them. So I'd say by and large, the investments have gone well. And as long as the investments go well, people are going to put more money into them. Once something bad happens, who knows? For the last 15 or so years, the economy's been growing pretty nicely. There are a lot of people with short memories. Bad things happen. The infrastructure-oriented engineering firms did pretty well during COVID. Other industries have been decimated. So something may happen at some point, and people will reevaluate. But and you can never anticipate those things. But for right now, I continue to see the interest growing.
Well, Ira, let's kind of switch gears here a little bit. Just talking about the typical investment model that private equity has, and specifically in the AEC space. Well, how would you answer that? What would you say is the typical investment model?
I would say typical investment model is providing the management team / owners some liquidity, and really teaming up with the management team to grow the business. So, I know what we do. I don't know what everybody does. We tend to view these companies as investments. We view them as we're partners with the management team. I'd say we've owned anywhere from 40% of the company on the low end, where we've been a minority investor, to that 60% on the high end, where we've been a majority investor. But by and large, we want the management teams to own about half the company, and we come in, we'll make an investment, we'll borrow some money from a lender, usually not a lot, and we'll work with them to grow the company. So something I learned very early on with a lot of these companies that are owned by multiple people is they live off, they became, they grew over time. A bunch of partners own them. They make most of their money on the equity distributions. They're owners in the company. They distribute the profits. And when you have a model like that, it's really difficult to grow the company. And the CEO of the first engineering firm we invested in, he said to me, I can never do an acquisition because number one, we don't have any experience. Number two, my partners don't want to go home to their significant others and say, we're not going to be taking distributions for the next few years because we're doing an acquisition. So that just doesn't work. What we need to do is get people some money in the bank, make their families feel good, and then we can focus on growing equity value. And growing equity value is the real way to grow these companies, because if you're just looking at distributions, you're missing a lot of growth opportunities, and you're sort of going to be stuck because you're not taking enough risks. So I forget what your original question was, Jeff, but that's
No, it was about the typical investment model, and you kind of,
yeah.
I think one thing you said in there that jumped out to me is sometimes personally with Lone Point, you're thinking about maybe sometimes you'll take 40% investment, sometimes more than 50. You usually try to stay around 50. Well,
we want to be partners with the management
determines,
team. What
you want to be
determines that?
partners?
It will do a majority investment or a minority investment. It really depends upon the goals of the management team. I would say in general, when I meet a company for the first time, I explain who we are, what we do, and then I ask them to evaluate their goals for a transaction. And so their goals could be, we've got one of our owners who just wants to cash out. We just need to cash them out, and we want a partner to help us grow the value of the company. So that's one model. Another is, a couple of companies we invested in, they were owned by entrepreneurs who owned a very large, significant part of the company, and they had their whole net worth tied up in the company. And they wanted to grow, but they felt it was prudent to diversify their net worth. So pulling money out and leaving money in made sense. So you start with what the company's goals are, and then you determine, what transaction meets the goals. So if a minority transaction meets the goals because the management team wants more upside, that's fine with us. If a majority investment meets their goals, that's fine too. It's easy for us to do a majority investment because with a minority investment, you need to deal with a little more documentation on what the management team can and can't do without us.
Mm-hmm.
But we view companies the same both ways. We work with them the same, and we interact the same and provide the same amount of strategy support and financing support and M&A support and everything else. So, by and large, it doesn't make a difference to us.
Very good. I guess a lot of what I see a lot of times in M&A deals with private equity, PE firms tend to come in and acquire, I'll call it a mid-sized to even large-sized firm that is considered what we call the platform. And then there's either, much smaller firms that get brought in that are called bolt-ons or add-ons to that. That's the most typical. There's other models I see where people don't combine the brands, but they keep the brands standalone, kind of as a group of a family of companies that they're putting together. But talk to us a little bit about that, just as far as what the mindset is behind the various models.
I would say that virtually all of the private equity investors in this space have focused on add-on acquisitions to grow the companies. It's really, especially I would say in the infrastructure engineering area, you could be a great engineering firm in, Cleveland, If you want to go to Atlanta, you can set up shop, and the clients in Atlanta have their own consulting firms. You can't just set up there and expect to grow. So most of the growth in the civil infrastructure area has been done through acquisitions. To do that, you really need to know how to do acquisitions. You need to know how to find them. You need to know how to negotiate them, to do the diligence, and how to integrate them. To integrate them, you really need what I call a full management team. So a platform generally needs what I would say a fully built out management infrastructure. So you need a good finance team, you need a good HR team, you need a good IT team. You need everything that would allow you to buy a company and integrate it in. So platform companies generally are a little bit larger. They're larger, and as a result of being large, they have built out that management team, and they're more suited to do what I call add-on acquisitions. I hate to use the word bolt-on. That just seems to be a bit of a derogatory term, but add-ons. And we've used, and I would say there are two different pretty distinct ways people have done this. We generally work with the management team and try to figure out what do we want to look like in 5 years. So I like to use CHA as an example. CHA, where you worked, Jeff, for a period of time, was in upstate New York.
That's right. That's how we originally met, actually, through Mike Carroll introducing us.
Exactly. So CHA was an upstate New York, Albany-based transportation engineering firm. And when we invested in it, the clear way to grow value was to expand geographically and to expand into other markets. So they were primarily transportation. So we used acquisitions to expand geographically into the Northeast, into Canada, into the Midwest, and into the Southeast. So we added additional vertical markets. We became much bigger in the water market. We became much bigger in the utility market, in the power market. So we used acquisitions to diversify ourselves. Diversification generally means more stability, because having a more diversified firm means if some things go down, some things will remain stable and go up generally. And so if you're more diversified, more stable, you're going to be worth more. And that's what we did with CHA. So we've used acquisitions for what I call strategic purposes. This is what we want to look like in 5 years. And how do we get there most effectively? There are other firms that have just grown through acquisition for the sake of growth. To be able to show people we can grow 20, 30% a year by doing acquisitions. A lot of those have worked. We just haven't done that. A lot of those have worked partially because the bigger you get, the higher multiple people attribute to you. People are generally valued as a multiple of EBITDA. So if you're a $5 million EBITDA firm, you're going to get a lower multiple than if you're a $40 million EBITDA firm. So a lot of people have just grown for the sake of growth to get that multiple arbitrage, which has worked well for a lot of people. We haven't focused on it that way. We've really focused on it. These are our strategic goals. How do we achieve them? Could be organically or through acquisition. And once we hit the point where we've tried to get to, we'll try to look at an exit for our investors. But both have worked. But in order to start, you really need what I would call a management team that's capable of supporting the acquisitions.
So, I guess for a firm owner out there, if they're contemplating, I guess, either some investment, needing some capital infusion to help them grow, or looking for an exit strategy, as you said, to be able to get some of their stock out of the business and convert it to cash. How should they look at themselves to determine whether they're a platform or an add-on?
I would say that to be a platform, you really want to manage. You want to be on top of the company, not in the company. You want to be managing the company. And the CEO of a company like that really needs to be a manager, not an engineer. I would say that's sort of the clear demarcation. When I talk to firms, it's, what do you like? I ask the CEOs, what do you like doing? If they say we like to work on projects, and work with our clients. That's very different than we like to manage the firm, and we're trying to develop strategies to grow it. So to really be a platform, you really want to be a true CEO and really want to focus on the management of the company. When we do add-ons, it's interesting. When we do add-ons, we're looking at a couple of add-ons for one of our portfolio companies today. And when I talk to the owners of the company, I say, what do you like to do? And they go, well, we hate this HR stuff. We hate this IT stuff. And, we don't know what to do about AI. And, and yeah, we've got a CFO, but their CFO is really a controller at best. We like to work with our clients. Those are perfect add-ons because essentially, our platform company has those capabilities. And we say to that CEO, what we're going to do with you is if you become part of our platform, you can focus on what you like to do. You want to work with clients, that's wonderful. That's a really valuable, attribute. But, if you want to grow the company, you need to team up with somebody because in order to grow the company, you need to invest in the management infrastructure.
Well, and I think that's a great point you're making there, Ira, that engineers and architects generally get into the business because that's how they're naturally wired. That's what they like to do. That's the fun of it all. And I've referred to it sometimes as different engineers, architects that they've become accidental CEOs. And I don't mean that in a derogatory way by any means. But what I mean by that is that they started their trade, they had fun, they were having success, they got more clients, they had to hire people. Many of them started their firm out of their basement, right? Or their kid's bedroom or garage or something like that.
Absolutely.
But they grow and they start scaling, and before they know it, they're no longer getting to do what they love to do, but they're kind of gotten stuck in this thing of having to manage a business, and that wasn't what they signed up for when they launched out on this.
Yeah, you have to like to do that. We've had CEOs which have really grown into the role, and they started with one person, and they may have 1,000 people today, but they've become like students of management. And when you have 1,000 people, then it's a firm that really needs to be managed. If you have 50 people, your CEO, you probably know each of the 50 people. They probably have all been with you for 20 or 30 years. You know their kids' names, their spouses' names, and it's a different way of managing a business. If you have 1,000 people and you're doing acquisitions, you need to manage it as a more by the numbers. You need to have the better financial systems in place, the better HR systems in place. Jeff, I would say your comparison is, I call it, I see it more in architecture than I do in engineering. It's a bunch of architects who happen to be in business. We like a business that happens to be in architecture engineering. So, a leader is a leader is a leader generally. It's good to have experience in professional services, but we need a firm that, knows how to be managed, as opposed to a firm that basically grew up and has a great client base, but really isn't being managed. And you need to, it's a different way of looking at a business.
Absolutely. And I love the way you said all that, Ira. And I think that could be very helpful to our listeners here that may be contemplating what their next move needs to be and where they kind of fit in that. Ira, tell us a little bit, how does private equity make money for its investors?
Well, that's easy. We need to grow the value of the equity. I mean, that's, we don't get investors unless we can grow the value of their investment. There are different kinds of investors. Obviously, if you're a debt investor, you're looking for a lowish type return. Better than the treasury market, less than private equity. Private equity investors are typically looking for 20, 25% compound, growth in the value. Everybody's different. Larger firms are probably looking at lower returns. Smaller firms are typically looking at larger returns. I was going to say it's not that difficult. It's completely achievable. And, on average, we've made over 5 times our money on these investments for ourselves and for the management teams. it's pretty straightforward, really. I mean, a little bit of leverage, a little bit of debt, a lot of strategy, using some acquisitions to position yourself to achieve your goals more quickly, and you could readily do it. It's really difficult, but it's straightforward. And the difference, I'll say, Jeff, that I learned a long time when I tell the management teams I'm looking to triple the value of the equity in 5 years, which we're trying to do. And the eyes roll. It's like, oh my God, it's taken me so long to get my company to this point. How am I ever going to triple the size of my company in 5 years? Well, number one, we're not asking them to triple the size of their company. We're asking them to triple the size of the equity value. And I explained to them how it works. And literally, I put together about a 30-minute presentation where I explained to people this is precisely how it works. Because I want the management teams are our partners. And if they don't understand how we do things, it really isn't going to work. So I sit down and spend 30 minutes and just walk through an example of this is precisely what we do. This is how a transaction gets started. This is what it looks like on day one. This is how you take money out. This is how you retain ownership. In the example I have, management team takes out 70%, 75% of their equity value in cash, puts it in the bank, but retains about a 50% ownership interest in the business. People don't understand how that works. So you get most of your liquidity, but you retain a lot of upside. And then I walk through with them, how do we actually grow the company's value? And again, it's straightforward. It's difficult to execute, but it's straightforward. And people, by the time I get through that presentation, people go, oh, is that all it is? And I go, yeah, that's all it is. It's obviously difficult to execute. People make mistakes on acquisitions. They make mistakes all the time. One of the things we add value to is we've made a lot of mistakes over the years. We're not going to make the same. We're not going to let the companies make the same mistakes we've made. Obviously, there's still new mistakes to be made, but we've been doing this for close to 20 years, and we're just not going to. We've learned how to do things better, and we've learned what not to do, and we try to stay away from them. So that's a long way of saying we're trying to triple the value of the investment over 5 years, not triple the value of the size of the company.
Mm-hmm.
Part of it is through just focusing on organic growth better than maybe they have. We spend a lot of time trying to figure out how to accelerate organic growth, to figure out strategically how do we create the most value, and to use acquisitions as a method to get there faster.
Well, I'm certainly not going to ask you to do the 30-minute presentation here, but if anybody here is interested in knowing, reach out to Ira Starr, and I'm sure he'll be happy to share that with you. Ira, one thing you mentioned there was the in your example, the 50% rollover investment that a selling owner might have going forward after you acquire the firm.
Mm-hmm.
And we kind of have something that we lovingly call the second bite of the apple when it comes to private equity. You want to talk about that just a little bit? Of course.
So when I talk about rollover, it's really, in general, the management teams, for say every $100 of equity value you own in the company based upon a certain valuation, we're generally asking the management teams to take $30 out of that $100 and roll it back into the company's equity to take out $70. So you're taking the bulk of your investment. It's in cash. You put it in a diversified portfolio, make your families feel good. The $30 we ask you to roll over. That $30 is really the second bite of the apple. So if what we're trying to do, to use that simple example, if you take out $70 up front and you leave $30 in, we're trying to triple the value of that over 5 years. So that $30 becomes $90. So that's the second bite of the apple. You take out $70 day one, you can take out $90, 5 years later. So what has happened in every one of our investments is the management teams have said, this has been a great experience. We want to do this with another private equity firm. And as a result, what they've done is they've taken that $30 million, which may be, 90, 100, $120 million. And they've said, let's do it again. Let's take 30% of it, roll it over. So let's say it's worth, $90 million. They may take another 60 million out, put it in cash, put it in the bank, take the $30 million and roll it back in. So we have two companies which are on their third private equity owner. And so the initial transaction took out money. They've taken out money 3 times. And the CEOs of those companies will go, private equity is the greatest thing to the engineering industry that's ever happened, because it's the ability to basically every 5 or so years to take out a bunch of money for the management team. Mm-hmm. Which, and I'm going to go a little further on the explanation, which makes it easier to attract really good management talent, because if you're a large private engineering firm and you get people equity, they don't know when they're ever going to get the money out. If you're a private equity-backed engineering firm, and we brought a lot of people into one of our portfolio companies, given them equity as an inducement to come on board, they know within a certain period of time they're going to get a big check. With a large private firm, you don't know when you're ever going to get money out. So it's really become a powerful way to attract really strong management talent who want to be part of a growing firm and would like to create some wealth for themselves and their families.
So, all right, yeah, I've seen it, happen multiple times where private equity firms help owners. Like you said, the second bite of the apple can be a bigger bite than the first one, and it can be a very lucrative proposition. And to your point, for repeatable, right? You can go through it several times. Several layers of management can go through it and get to benefit from it.
Absolutely. And and you say several layers of management. It's interesting because a lot of the firms we've invested in, the management has changed over completely over the years. CHA, just because I use that as an example, the entire management team we started with changed, during the course of our investment period. Because they all retired, we bought their stock in over time, and we promoted people internally to grow the company, and it becomes a market for as people retire. We provide it to other people in the company. So it tends to be a great mechanism. Not everybody's going to be there forever at every company. So you need to build in management succession, and it's a great way to do it.
Well, Ira, as you pointed out at the start of our conversation, people being very important in this industry, in the AEC space, and culture being very important. We hear a lot out there when it comes to private equity. That's probably where I hear the most negativity is the cultural conversation related to private equity. What are your thoughts on that? How do you know if your culture is right for private equity?
Yeah, I would say that for 95% of the people at any company, their day in, day out lives is exactly the same pre our investment as post our investment. We have the people, engineers tend to be a pretty dedicated crew. They want to serve their clients, and they're going to continue doing that. It's really the top layer of people that need to focus more on how do we grow the company. So, somebody serving their, state DOT client, they're going to be doing that. It's not going to change a lot. What they're going to see is, if anything, I've seen the cultures really become better because they've become growth engines, and there's just much more opportunity to grow, as far as a career. So as far as the platforms go, it's the same company going forward as it's been in the past. It's the same culture. It's the same company. Every company has its own unique culture. Everybody thinks they're completely unique. Most of them are pretty much, the same. But every company, people are going to be working day in, day out, doing the same thing. And all we're trying to do is, I guess, number one, we're trying to figure out what do we do to make it more valuable at the end of, say, a 5-year period. How do we make it an employer of choice? Because the only way to make it a great company is to become an employer of choice, and to really add the resources to figure out how to grow the company. So, every company we've ever invested in, we've added a lot more management resources because typically most of the companies are underfunded in a lot of areas. They're focused on serving their clients, Usually the
Mhm.
CFO is the person they spend the least money on because they have to deal with the people, so they typically do HR. They need IT because they need systems. CFO, is typically an area that could be improved, not always. So we're just focused on how do we put the right people in the right seats, to grow the company. And culture wise, I've gotten thank you notes when we've, you know, got into liquidity for everybody. It's like, gee, we heard what you said up front, and we weren't sure what to expect. We respect our CEO, and he wanted to do it, um, but it worked out great. Thank you, and
Mm.
that's been so the unanimous opinion of a lot of people. Should
Well, that
save you
sounds like a
emails.
win-win.
Knock on wood, it's really worked well. I mean, it's worked well. We love to work with smart people, engineers, their leadership are smart people, and we show them a little bit of a different direction on how to take the company and grow it. People buy in pretty quickly.
So, Ira, I guess as we're wrapping up here, you have two investments in the AEC space, I believe, right now.
We do.
M&S Engineers out of California, and All North out of Canada.
Correct.
Um, uh, you want to just tell everybody here what you're kind of looking for as you're growing that, and
Yeah, sure. Very different kind of companies. M&S is an infrastructure firm, really focused on transportation, water, and other government services, primarily planning services. They're more construction management than they are engineering right now. We're trying to make it much more of an engineering firm now too. So it's construction management. They're basically in the field making sure the projects are constructed per the design for their clients. So we have a lot of people in the field. The idea where M&S is primarily Central Coast California between LA and the Bay Area. We're expanding rapidly into Southern California now. We're looking to expand into Northern California. Um, our focus is on California. Could it be someplace else in the Pacific time zone? Sure. But California is just an enormous economy. I think it's the fourth or fifth largest economy in the world after
Mhm.
Germany. So, and it's, California is like 5 states in one. So we're in like one of the states out of the five, and there are other states to grow into there. So it's working great there. I think we started, the company was probably 145 people. Now it's about 200 people, 210 people. A couple of years later, we've added a lot of management talent at the top, and it's worked super. And I think people, you know, we're having a lot of people reach out to us because they want to join us. So we've really become an employer of choice, which has really been key. And we're looking to do acquisitions. We have, half a dozen acquisitions in process one way or another that we're trying to bring to a close. All North is a different kind of company. All North is just, it's an engineering firm. It's primarily civil engineering and construction services being survey, material testing. Different markets in Western Canada. The markets in Western Canada are infrastructure also, but also mining, pulp and paper, and oil and gas. Oil and gas, more midstream pipeline, which is more
Mhm.
infrastructure. Mining is a lot of infrastructure. So they provide a lot of the same services. We are looking to grow and diversify that company through acquisitions too. They I think they had about 600 people. They have about 1,000 people today. So they've been growing pretty rapidly. We did a pretty significant acquisition a few months ago. So it's going great. This is a company, the CEO there grew it from one person to 1,000 people. So he's a true entrepreneur. Um,
Wow.
but he's not only a true entrepreneur, he's really become a student of management. He's always looking to manage the company better. So he's been a pleasure to work with. So we've added a lot of people too. In the you know management team, we probably have added half a dozen top level people from other engineering firms. So it's been a good ride so far.
Well, very good. Well, Ira, thank you so much for joining us today and just kind of giving us some more insight into the private equity and its interest in the AEC space. I want to thank everyone for tuning in to AEC Unscripted, the Mergers and Acquisitions edition. I'm Jeff Adams, and it's been a pleasure guiding you through the ins and outs of private equity and the AEC industry. Please remember to subscribe and leave us a review wherever you get your podcast. And until next time, keep pushing forward.